Good evening, everybody. Uneducated Economist here. Well, it's only a matter of time now before the Federal Reserve actually does some quantitative tightening. Of course, long before they do this, there will be plenty of job owning and forward guidance letting the markets know that they will be doing the quantitative tightening so that they can prepare themselves and that there won't be a shock to the system. It is going to take place at some point in the future. A lot of people will argue with this, saying that the government can't afford it or that, interest rates would just be too high for them or something like that. I wouldn't hold my breath on it. That's all I can say. Now, you can already see that the Federal Reserve is going to have to do something with all the liquidity sloshing around in the system. There is far too much of it. I'm going to leave links down in the description talking about how there's too much dollars in China. There's too much dollars in the U.S. banks. There's too many dollars at the money market funds. There's just too many dollars out there in the system, and it's going to start creating havoc if the Federal Reserve doesn't do something to start mopping it up. And they are trying their best with this reverse repo market, which is now up to $500 billion in a day, which is really hard to think about when you consider that the Federal Reserve, the entire balance sheet was like $850 billion back in I don't know, 2008, 2007, something like that, before the whole quantitative easing even began. So if you can imagine that like $850 billion was the entire balance sheet of the Federal Reserve and now it's up to $7 trillion, that is a huge difference inside of the markets. And then just the reverse repo is now 500 billion. I mean, the amount of money that has been printed up is just astronomical. It is just insane. But all this is to cover up what is going to be the eventual collapse. Now, how far out that is and how long it takes is anybody's guess. But you can see it already with the massive amounts of zombies. Now, a zombie is somebody who cannot exist without some sort of money coming in. Now, generally, when people are talking about zombies, it's usually zombie corporations who would not exist if it wasn't for the incredibly cheap debt that they can gorge on. There is so many people out there and so many institutions and pension funds and just investors in general who seem to be willing to throw money at these zombie corporations, even though the moment that it turns and they are no longer able to get that debt, it's all over for them. And it's not just corporations you have to worry about, it's zombie people too. People who are pretty much living on their unemployment benefits, who have not been making their payments, who have, as far as rent or mortgage payments or whatever. When the time comes that all that, it's over for them. They can't exist. They are a zombie. The only way they function right now is with all this other support that keeps them alive. The moment that it's over, it's done. Same thing with the corporations. And now you can see that there's a problem with the corporations defaulting on their bonds. Just look over at China. That is going to happen here in the United States. Like I said, I'll leave a link down in the description. Just look at all the articles that I leave in this video. And it'll really paint the picture of what's going to come once all this stuff starts to come to an end, which a lot of people believe is not going to come to an end. It will. They have to do it. And it doesn't, they don't have to do it. Like, they don't have to, but they have to do it if they really want to push in all those dream ideas that everybody has. Like, if you're dreaming of the MMT kind of thing, if you're dreaming of the central bank digital currency just depositing money right into your wallet so you can spend it at will on anything you want, that is going to come with some serious law changes. And in order to make that happen, people have to be willing and forcing Congress to do it. And that takes a lot of pain. It takes people being crushed, losing everything they have, blood in the streets kind of thing. And then they'll make the change and everybody will be real happy with what happened there with the change, because all of a sudden, interest rates will go negative and everybody will have this money in their pocket and they'll just be singing the praises of central bank digital currencies and negative interest rates, not realizing that they are forever pushing themselves into a life of eternal slavery, which is the only way I can really describe it. It's hard to put all this stuff into a single video for somebody to understand. Like, I had done a video for Grandma Prepper the other day trying to really explain something very simply, and I got a lot of people who jumped all over me for it, which is fine, because really, if you think the cause and effects of things, there is two ways to look at, there's two sides to every coin. So you can talk about the cause of effects from now on a particular topic, and debate the idea back and forth. But something that I noticed in the comments right after that was there's a lot of people who are really trying to understand what is it that is taking place inside of the economy. And there are so many changes, and it is so complicated, and there are so many different avenues of approach when it comes to trying to understand things, that it just seems overwhelming for a lot of people. And a lot of it has to do with just the lingo. I know I'm kind of trailing off here, but whatever. So, and I know a lot of it has to do with the lingo. And like, for example, like Grandma Prepper, she was really like, could you just explain what quantitative easing is and how that affects the economy? And I'm thinking, wow, with the quantitative easing having taken place for the last, 12 years or whatever it is, I forget that it's like, it's hard to, like, it's not common knowledge. Like, I forget that this stuff is hard to wrap your head around. Like, it just starts with like the bond market. And like, if you don't understand bonds, then it's really going to be difficult to understand how quantitative easing works. So, when she says, could you explain quantitative easing and how it affects the economy? And it's just like, wow, let's start with the bond market. What is a bond? A bond is, it's a debt from the government. So the government wants to spend money. Well, the way it does is, writes an IOU. It gives it over to people. And with that IOU comes an interest rate. So you can buy these bonds at different durations, all the way from like, one that's going to pay off in just, at the end of the month, all the way out to, many years into the future, all the way out to 30 years. So this is like the sovereign debt. So a lot of people, when they hear like the bond market or government debt or sovereign debt, they're talking about the same thing. And there's a bunch of ways that you can kind of refer to this bond market. But the neat thing about government bonds is that they are guaranteed to pay. 100% guaranteed, never going to fail. You are going to get your money. Alan Greenspan said it best. The Federal Reserve the U.S. government will never default on a bond, because they have the Federal Reserve, who has a printing press to always print the money to buy them, to pay for it. So there's zero chance of default when it comes to a U.S. Treasury. Problem with it is that they cannot guarantee the purchasing power of what comes from the Treasury. So when you tie your money up, when you hand it over to the bond and buy a bond, you're basically handing it to the United States Treasury, the government, to spend. You are giving up your money, and you are saying, okay, I am giving this up so that I can be rewarded with an interest rate. Now, once you have that bond, you can sell it. So even if you don't want to hold on to it for the 10 years, you can sell it halfway through. And if the interest rates go down into the future, that means when the purchase price that you have got your bond for, well, now you're going to be able to sell your bond for a profit, because the future interest rates on bonds have gone down. Now this part right here, and it's the yield that they're talking about. There's two things that comes to a bond. Their bond has the coupon rate, which is the actual interest rate that the bond pays, and then there's the yield. And the yield is very different from the coupon rate. Now, this part is probably the most difficult thing for people to understand when it comes to bonds. The coupon rate and the yield. They see these things, they hear about them, they don't understand what the difference is. Now, I'm going to try and explain this as easily as I can. The reason why they call it a coupon rate is because when you bought a bond, if you bought a 10-year bond, it would be a face value to the bond. Say it was $100, and it would be for, say, 10 years. At the bottom of the bond, there would be 10 coupons. Once a year, you could rip one of those coupons off and go and cash it in. That would be the face value from the face value. So if you had a 10% interest rate on that bond, you could tear one of those coupons in and go and cash it in for $10. You could do that every year for 10 years. And then at the end of the 10 years, you can cash the bond in for the face value. I mean, that's the simplest way to kind of explain it. Now, say you bought that bond, $100, coupon rates, you had it for a couple of years and you decide you don't want the bond anymore. But interest rates have dropped into the future. They have gone down. But your bond, that what you paid for it, well, that stays the same, the coupon rate. But what you can sell it for now goes up, because what the investor is now looking at is how much the bond will yield them. Now, this is very important. They're looking at the bond. It pays a particular interest rate. But new bonds into the future, the interest rate has dropped. Not so much what the bond pays as far as the coupon, but how much the bond cost. That's the difference. So when the cost goes up, what the investor is going to get back from the coupon is going to diminish. Now, the coupon stays the same, right? It doesn't change any, but the yield that the investor will get from having paid for that bond, paying a higher price for it, that causes the yield to drop, what the investor will get from that bond. Does that make sense? I mean, that part is really difficult to understand, that there is a bond with the coupon rate. The bond itself has a price tag to it that can adjust. You can pay, it can go up or down. You got an investor out there who goes, hey man, you got a pretty nice bond there. What these other investors are selling their bond for are so high. You got one that has an interest rate that, is 10%. To me, it doesn't matter if I buy this bond or your bond, but lucky for you, you can sell it for a profit because of the interest rates that have dropped and the yields in the prices going up. So really difficult to kind of wrap your head around that one, but it's very important to understand. And the reason why you want to understand that is because bond investors had turned into speculators. See, they used to buy those bonds thinking, okay, I'll just tear those coupons off once a year. They're not really coupons anymore. You don't buy them with coupons. They're all electronic. But ultimately, you could buy these bonds that had coupons to it that you would tear off. That's what the investors looked at. They would be like, okay, how much does the bond cost? How much are the coupons rate? And you're thinking, okay, well, that yields about, 8%. That's pretty decent. I'll buy that. And that's what the investor would look at, is how much they are going to be yielded from this bond, how much they're going to earn off of it. But now they don't really look at bonds as like part of something that they're going to get a yield from. What they're more worried about is whether or not the price is going to go up or down, because they're anticipating on selling the bond in the future for a profit. So they don't really care about the yield. The yield is so low that it doesn't really interest them. Like tying their money up for 10 years for a 1.5% interest is not a very smart move. You're never going to, you're not going to beat inflation. You're going to lose your purchasing power by tying your money up for 10 years. That's not what the bond investor is interested in. What the bond investor is interested in is whether or not the interest rates or the yields are going to drop into the future, because if they're dropping, that means the prices are going up, and if the price is going up, they're selling it for a profit. Now, this is important to understand. You got to, because if you're going to understand what quantitative easing is, this is the whole point of quantitative easing, is to get the investor to believe that the Federal Reserve is going to be buying into the bond market. See, if they have that confidence, if the market looks out there and says the Federal Reserve is going to be buying $80 billion worth of U.S. Treasuries every single month, then we know that there is a buyer. There is a guaranteed buyer for these bonds. No worries. See, now typically you would have to think about the entire world market trying to buy into these bonds, which a lot of people do. I mean, the entire world has an appetite for U.S. Treasuries. And the reason is that they're almost as good as dollars. They're about the closest thing to a dollar that you can get with not actually being a dollar, which is really important to understand as well, because most world trade, when it's done in U.S. dollars, but more importantly, it's done in U.S. Treasuries, because people would rather trade a U.S. Treasury than hold U.S. dollars. Because U.S. Treasuries, you can at least get a tiny little bit of interest rate off of it, where a U.S. dollar, you won't get any interest rate off of it. So, with all that being understood, if you can kind of wrap your head around that, I mean, if you're new to the game, then your head already just exploded with that kind of information. But that's what the Federal Reserve is now buying, is those U.S. Treasuries, bringing that confidence to the market. That's the whole point of the quantitative easing and the purchasing of assets, is to keep those yields low, keep the bond prices up, keep the investors interested, making sure that there is a buyer out there, the Federal Reserve, and that is the game that they play. They also do that with mortgage-backed securities. The mortgage-backed securities is the other part of the quantitative easing. So they buy $80 billion worth of U.S. Treasuries every month and $40 billion worth of mortgage-backed securities. Now, mortgage-backed securities, this is as if they took a bunch of mortgages, like, I mean, you can't really, just put it down into, just something simple. I try to explain securities as simply as I can, but I talk about it almost too simply. But if you can imagine a box and you throw a bunch of mortgages into a box, right? That box becomes the security. You can sell that security off to investors. As the mortgages get paid, the investor gets the interest rates plus, eventually the principal payment on the loan. Once the loan is all done, the investor is pretty much completed on the mortgage-backed security. That's kind of important to understand because when a refinance happens, it pretty much eliminates the loan and reestablishes a new one. So these mortgage-backed securities, as there's a big wave of refinancing, can turn over very quickly. Meaning that if the mortgage-backed security usually ends or is paid off, because usually the investor gets paid off, they roll that into another mortgage-backed security. So this is where refinancing can find momentum in taking place in the mortgage-backed security market. Once the refinancing stops, there's no new mortgage-backed securities coming onto the market. The demand for mortgage-backed securities can rise and the interest rates can fall as the demand for these mortgage-backed securities increases from the investors. That has, from what I understand, has not happened yet. I haven't seen that, but I would only assume that it's just a matter of time that the quantitative easing is going to have to be adjusted because of the U.S. Treasury purchases. Now, I'm assuming that's where we're going to see the adjustment first. And the reason is that there is so much liquidity now in the system. I will try and leave links down in the description for all this stuff, but there is articles coming out of China, out of the U.S. banks, out of the money market funds. There is liquidity everywhere, and people are pretty much saying, find another place to go with this stuff. And now that's where the Federal Reserve reverse repo comes up to $500 billion every single month. This is where the Federal Reserve is okay, well, we'll try and get this cash out of the system, at least on an overnight basis, to find a place for you guys to put it. Now, if they did not do this, a lot of these money market funds might shut down. They would be like, you know what, we're out of the game altogether. We do not want to do this. Already, they are complaining about having to eliminate their fees. They're not making any profit. They're really not even interested in doing this any longer. And this is where the short-term funding takes place. This is where the beginning of the financial markets began. If you can remember, the great financial crisis started with a big drawdown in the money market funds. People started pulling their money out of it, and all of a sudden the rest of the financial market started to freeze up because of it. So money market funds are very critical for the whole banking system, the financial markets. They have to continue to function. And that's where the Federal Reserve is really stepping in with this reverse repo. Now, here's the thing. It seems just so easy. All they have to do is just turn the water off at the top, and they wouldn't have to pull it out from the bottom in the reverse repo, right? You end the quantitative easing where they're buying those treasuries, and then they wouldn't have to worry about so much liquidity being in the system. I mean, that's the simple way to kind of understand it. The only thing is that the Federal Reserve is mandated. And this is another thing where it starts getting complicated. They are mandated to do two things. Low and stable prices of around 2% target inflation average, which is new. I mean, it used to be just a 2% target. So if they're under the 2% target, they shot for it. If they went over 2%, then they tried to go back down to 2. Now they're going to go for a 2% average, which means that for the last 10 years, since they weren't able to achieve their actual 2% target range, they are going to let inflation run extra hot for extra long to make up for the fact that they weren't able to achieve that 2% until they can get an average rate of 2%. Anyway, they also, and this is important, mandated to have full employment. Now, low and stable prices, which they're kind of failing on, but it's an average inflation rate now, so it's okay to have, higher prices that aren't stable because it's average pricing now. But this full employment, this is a difficult one, right? I mean, there's 8 million less jobs now than before the pandemic, all these job opportunities out there that nobody wants because they're low paying slave wages jobs that everybody says is not worth going to. So this is going to be a little difficult for the Federal Reserve to try and reverse their stance if they are not meeting their mandate. However, I feel that that mandate is probably going to be achieved fairly quickly. So until they achieve that mandate, there is no way that they are going to adjust their monetary policy. Once they adjust their monetary policy, everybody's going to behave differently. So there's no way anytime in the near future that they are going to do anything at all, except for maybe continue on with the reverse repo thing like they're doing, and a whole lot of talk about how much tapering they're going to do into the future. Okay, with all that being said, once the unemployment rate begins to drop and starts to reach that full employment, that's going to take place here when the moratoriums end, when the unemployment bonuses, when all those like stimulus relief plans, when those things come to an end, people will run out and get the job. It doesn't matter if they want the job or not. They're going to be in a critical position, and they are going to take it, and they are going to scream. They are going to scream loud, and people are going to be mad, and there's going to be like people protesting in the streets, and they are going to demand that the government do something. Now, how long this takes, I couldn't tell you. But it's going to happen at some point that they are going to demand that the government do something, and that's where the big shift into the central bank digital currencies will come. But up until that time, they will, from this point on, begin the process of tightening. But it's all going to start with a whole bunch of talk and very little action. Now, once that all does take place and people start getting into the central bank digital currencies, interest rates will go negative. They'll go negative once they have the cash out of the system. Now, a lot of people are going to argue with this one again about how they already have negative interest rates in other countries. Yes, that's true. They have it into the banking system. It has made its way into some of the deposits of like the people's deposits, but it was, from what I understand, only like the very incredibly wealthy people who had like hundreds of thousands of dollars sitting in the bank that they were telling them basically go do something with this. That is a little different from like when you go and you put your money into your check, like you deposit your paycheck and that has a negative interest rate attached to it. People are going to be very unhappy with that, and they are not going to deal with that very well. And so if they have cash in the system, people are going to pull their money out in cash right away. So they're going to have a central bank digital currency in order to deal with the fact that there's cash in the system. Once they have this central bank digital currency and everything is up and running, they can go as deep into negative interest rates as they want. Well, I don't know if they can go as deep, but they can try to go in as deep into negative interest rates as they want, because there will be nothing to stop them from doing that. They're like, right now, if somebody was to apply a negative interest rate to your bank account, you would just go pull all your money out in cash, because it's better to hold cash even if you're losing it to a purchasing power, but it would be better than losing it to a negative interest rate. So this is like the things that I see coming into the future. Now, I think probably the most important part of this whole video is the zombies. Watch out for the zombies. There is going to be a lot of corporations that begin to fail. And from what I understand, prior to the pandemic, it was already increasing dramatically, the amount of zombie corporations that were out there. And if you start cutting off the lines of credit to people, it's probably not going to go over very well when it comes to corporations trying to continue to fund themselves. That is going to cause like a collapse in the system. And I couldn't imagine it happening like quickly. What I see first is a lot of stock buybacks going back into stock sales, so that you will end up seeing the stock market kind of going down at the same time that these defaults are taking place, as these corporations begin to try and survive at any way they can. So if they had been buying up a lot of their own stock, then I would imagine that they will probably try to sell a lot of that stock to pay their bondholders, and that's not going to do well for the stock market. This is going to create a situation in which there's going to be very little places to run. Think about it. Real estate's ultra high, bond market's ultra high, the stock market's ultra high, and there's really no place to go to. Now, a lot of people are going to say, like, you need to get into gold, silver, cryptocurrencies, all this other stuff. And that's probably like a good way to go about it, but nobody knows like exactly which one of these things is going to be the ticket item. I mean, everybody who's like absolutely like, I am going to put everything I got into this one thing, will make it incredibly rich. They will be wealthy beyond their dreams if they hit it. What is it going to be? Uneducated economist. Kind of a weird one there, huh? You guys let me know.